Good morning, good afternoon, and good evening. It's February 24, 5:39 p.m. Central Standard Time. Welcome to another episode, episode 69. Believe it or not, more outflows. Again, this is Mark Yu,
And Wawi Santos.
and welcome to the Mark Yu and Huawei show. So, just a disclosure: we're both not a registered financial planner, but we both work in a healthcare profession. And we have the same passion and interest in investing our hard-earned money in the stock market. So we try to record at least once a week and see where the money's going and what's the latest trend. Um, and overall, we're both long-term investors. We try to keep our money invested for the long term and reap the benefits of that. So in last year, 2022 wasn't really a good year for any investor. I guess if you're a bear investor who's always betting that the market would go down, last year would have been a terrific year for you. Well, for the rest, I believe it's been a very not terrible, but very difficult year. So here we go. So for our first part, it's the survey sentiments. So what investors think if the stock market is going up, going down, sideways, or neutral. So bullish is going up, bearish going down, neutral is, passive. So as of a couple of days ago, February 22nd, there has been a lot less bullish investors. Wow, look at that. From February 8th of almost more than a year high of bullish sentiment, after 2 weeks, we have erased nearly all of that. 21.6%. I guess this has been the average of 2022. We were in the low 20s, if not even in the mid-teens in terms of bullish. And bearish, look at that. It's back in 38.6 levels. So this is again above the historical average of 31 and definitely higher than past 3 weeks. But yep, it's getting there again. People are getting more bearish, getting less hopeful, less optimistic about the market.
Yeah, with the S&P 500 dropping below 4,000 today, based on the hot PCE inflation report being higher than expected, it dropped significantly today.
Right. Take a bit.
Nasdaq down 195 points today as well.
Yep. Quite a bad week as well for the past 5 days. Nasdaq, like what we said, is down. For the past 5 days, it's down 3% to 11,394, while the S&P 500, which contains a lot of big companies, 500 largest companies here in the US, they're down 2.63%. While the volatility, the VIX, it's up nearly 4%, 21.67. While the Nasdaq volatility, it's up 1.15%, up at 27. And for the fear and greed index, believe it or not, we're still in the greed. This I definitely doubt. I don't think we're in the greed anymore. But according to this survey by CNN, we're still in the greed. Past week we were at 68. Right now we're at 59. And the bullish sentiment for market momentum, it's nearly gone. So for the past 125 days versus the S&P 500, we are close to retracing it all back down to the average. So we have been going down since actually Valentine's Day. So no more Mr. Valentine for Mr. Market, not wanting to give out more greens, more returns, positive returns to its investors. Otherwise, it's been trending down since. Put and call options. Looks like definitely we're trending up. People are buying more put options to protect their portfolio against any downside. And for the group performance for the past week, we are seeing Each and every sector on the bloody red mark, led by consumer cyclical, which are the some of the tech companies as well, communication services, Facebook, Snapchat, whatever, real estate, technology, of course. We're back to that range where people are dumping their technology shares again. Oh, meanwhile, if you're gonna take a look at year to date, since the start of the year, can't believe my eyes, but technology is actually up as a sector, up 10.58%, followed by consumer cyclical. So I guess what's happening right now is the reverse of what's been happening since the start of the year. At least for the past 5 days alone. People are selling their winners right away. If these are retail investors, Huawei, that are selling, so it just means that a lot of people are panicking right now because of the inflation reading, the high inflation reading.
Yeah, that's true, Mark, and that's also um, running the US dollar index up again at 105 today. We know we've been seeing a downtrend on the dollar index, but with with what's going on recently, we see another rise in the DXY, or the US dollar index.
Right, definitely going up, at least for the past 5 days. Wow, look at that. From 103, now we're up to 105 for the past week alone. For the past month as well, from 101, now we're at 105. So what an inflection point. Since February 1st, dollar index low point, we've been trending up again. So probably this is because of the anticipation that the Federal Reserve would still have to raise more interest rates. That way, this would, in order to control the inflation. So people are selling stocks, just holding cash, increased demand in dollar as a storage of value. Not even gold. Actually, gold has been on a sell-off. If I can pull up a chart right now. I just saw it this morning. Gold has been trending down as well, and not a safe haven. If we're gonna talk about a safe haven, dollar is actually the safest. Just holding dollar at this point of time. So you can see here from January 6th, $1,943 an ounce. Now we're down to 1,800. So not even the safest of them all, as one would claim gold to be. It's not a safe haven to be parking your money on right now because of the Federal Reserve hiking up rates. Everything is on a sell-off. And right now we're just going to take a look at the fund flows. So this is fresh from the oven, 2 hours ago, published by Reuters. US equity funds see biggest weekly outflow in 7 weeks. I don't know, Wowie. I think I'm getting tired of this headline. There's always an outflow.
Well, this time it may be based on uh, quite a bit of economic data coming in. You know, um, with our trade war with China, you know, we're, we're not getting any supplies in the country that that will level out the you know the demand. There's still a high demand in this country. People are still buying. They may be getting more in debt, but they're still buying products here in the US. But the problem is the supply is not leveling out the demand, and this is partly what's driving the inflation here in this country.
Right.
We
Consumer Yeah. Oh, sorry. Go
We
ahead.
we might not get a soft landing that we're expecting now that we're seeing that inflation is really a very strong force right now because of demand supply issues.
Well, as well as consumers. Right now, consumers are taking more debt, like you said, to finance their expenditures. What happens if they reach their, or when they reach their limit or started defaulting on their cards, their credit cards, and that will hit the economy pretty hard. But that's on the future. At this point in time, I think, yeah, like you said, stock investors are quite wary about, you know, more federal rate hikes coming down the road. Well, according to this article itself, Reuters is saying US investors are hit by worries over higher interest rates as strong economic data pointed to the US Federal Reserve sticking to its higher monetary policy for some time more. So definitely more interest rate hikes, a lot higher interest payments, a lot more difficult for business owners to lend or borrow money to finance their businesses, thus pointing to a possibly, like you said, not a soft landing anymore down the road. But we'll see how that goes. So investors pulled nearly $7 billion out of U.S. equity funds, their biggest weekly outflow since January 4. So there's force behind this sell-off for the past 5 days at least. Now that we have registered the biggest outflow, large and mid-cap funds suffered weekly disposals of 5.7 and 5.7 billion and 389 million respectively. Small cap, wow, small cap only people only withdrew 79 million from small cap. So meanwhile, industries that has suffered a lot of outflows, of course, technology with 856 million outflows, followed by real estate, 603 million. Mhm. Discretionary and utilities lost about 300 million as well in outflows. So the job report actually indicates a strong activity. Unemployment claims are fewer, so people are looking to work and finance their credit card debt. So they haven't defaulted yet, or not in that kind of mind frame at this point in time. I'm not forecasting that we're gonna experience a lot of defaults coming down the road, but I think, correct me if I'm wrong, Wawi, I saw an article over the weekend, last weekend, is that a lot of auto loans are being defaulted on, especially by the high risk borrowers or those who have low credit scores. So that's kind of a worrisome finding, especially for those banks who are heavily exposed to auto loans.
Well, that is reflective of the market reaction today.
Mm.
One of the sector, there are two sectors that benefited on the news today, and that's financials, and in the commodity sector, the material sector. Where that so financials and materials did well this day, signaling higher interest rate repricing of the market.
Mhm. Yep. And now we're gonna jump on to a couple of earnings. We have Walmart and Wayfair. So for Walmart, it's one of the largest companies here in the US. It's actually valued at $383 billion in market capitalization. In terms of its price, it's $142 a share, which is above its 52-week range, where its lowest was at 117. So quite a ways from that, and the highest was 160 bucks a share. So according to this Seeking Alpha article, it says Walmart beats its earnings per share estimates, and also it beats its revenue estimates, which is really good. It means that Walmart is sticking to it despite the high inflation narrative all over the place. So I think I got their earnings report pulled up here. So according to their CEO, we are excited about our momentum. The team delivered a strong quarter to finish the year. And as our results in the last 2 quarters show, they acted quickly and aggressively to address the inventory and cost challenges we faced last year. We built momentum in the third quarter, and that continues. We are well positioned to start this fiscal year. So nothing but confidence from its CEO. And if we're going to take a look at their numbers for 2023, that's their fiscal year for last year. Their total sales are up 6.7% to $611 billion from its previous year, while their profits in their 2022, it's down actually 15% to $11.68 billion. Regardless, it beat Wall Street estimates, which is the primary reason why their stocks are holding up. They have a good amount of cash, $8.8 billion compared to $14.7 billion last year. So they're quite liquid. Wow. But their long-term debt is quite high as well. Their long-term debt is 34.6 billion plus 4.2 billion. So about $39 billion in debt. But nonetheless, it looks like they're in solid financial standing. They've paid out about $6 billion in dividends and $9.9 billion in buying their own stock. So quite a solid company, generating more revenue instead of falling. So not to be unfair, but we have a Wayfair comparison here, definitely playing in a different ball field. This company is a small cap, I believe. It's $4.16 billion. It's close to its low 1-year price range, $37 a share, whereas its lowest was $28. So reason I'm including Wayfair here is like because they've I think during the early times that we were recording Huawei, we had Wayfair more than $100 a share, $200, and now it's just trading close to $20 a share. How times have changed. So
Yeah, it was a sought after furniture company at one time, growing remarkably, at least 2 years or 3 years ago. Quite a
right.
bit of downtrend for this company.
Oh yeah, totally. And it just shows that if you're purely online and if you don't have any stores, you could definitely mess it up big time, as investors are now fleeing what seems to be a previously a wonder stock. So Wayfair, it says here they missed their earnings estimates, but they beat their sales estimates. What's actually surprising here is they have announced something about their user count. Let me see. Number of customers, I think, for the company declined a lot. So active customers, there you go. 22. Well, it's hard. Maybe you can find it from another article here. So this is from a Barron's article. So Wayfair just registered its worst one-day decline ever yesterday when it reported their fourth quarter results. Although, Wayfair said that they're confident still in their cost initiatives. I can't seem to find where the exact value of active customers dropped. Maybe it's on Bloomberg. But one thing I would just want to highlight is like people are now avoiding spending a lot of money online, especially on furnitures. In this case, it hits solidly strong on Wayfair's bottom line. All right. So next topic we are looking at is a Bloomberg article. So this is pertains to one of the commodities that we have been taking a closer look at since last year. It's actually behind the reason behind Exxon and Chevron were the biggest outperformers last year. It's no other than oil. So in addition to the stock market falling off the cliff, what's the other one? The gold price falling down. We also have the commodity oil going down to 75 bucks a share. Bucks a share. $75 a barrel. This is the longest losing streak this year. Well, we're close to the end of February, believe it or not. This is because of the even stronger dollar, and also fundamentally, US crude stockpiles increased to its highest level since May 2021, according to the Bloomberg article. So quite a change there. Nonetheless, I think Exxon is still holding their gains, if anything. Wow, look at that. Exxon is still up 4% since the start of the year. I thought it was already down because of oil's performance. While Chevron, oh, let me see if I could get a good price update for Chevron. Chevron is down 6.66% since it started here. I'm not saying that Exxon would suddenly price collapse, but quite an interesting finding. Looks like Exxon is the stronger of them both in comparison to Chevron in terms of price performance. Uh-huh.
Some changes, but it's just
Right. I think maybe we have some static there. I'm not, maybe it's my connection. But yeah.
Okay.
Oh, there. That's much better. Can you repeat
Okay.
the last statement that you said about oil?
Yeah. So the oil ETF reflecting oil and gas in Europe, ticker OIL, is just showing a little bit of decline, about 10 points. But like I said, it may change when their market opens. But it's still a strong performance for the year, like here in the US.
Yeah, I agree. And Exxon remains to be a solid one. So we're jumping on to the next. We have here an update on the real estate. So US home purchase applications dropped to 28-year low. Wow, 30 years. Nearly 30-year low as rates jump. So a lot of people are postponing their purchases for the stock, for the housing. We're gonna take a look at the 30-year fixed mortgage as of today. It even went up 6.88% for a 30-year fix and 6.25% for the 15-year mortgage. So not a good sign for the real estate market at this point in time. If you're going to be buying, locking in those rates, especially those already have been built. For those who are looking to new construction, you may still have the option not to lock in your rates this early, because new builds take quite some time to build, 6 to 8 months, at least according to one of the builders that I've spoke to. And next here, another headliner from Bloomberg: U.S. housing market posts 2.3 trillion drop, biggest since 2008. A lot of value is being wiped out right now from the real estate market. Value of U.S. housing market shrunk by the most since 2008. So this is as of second half of 2022, according to Redfin. So if you have a house and you don't really need to sell, it's better to hold on to that property at this point in time, or at least rent it out if you want, if you're not going to live in it. But if you're hoping to catch a higher bid, I would say good luck. Right, Wawi?
Yeah, yeah. It's reflecting all the outflows for the day. We might see more of that near term.
Price pressure, for sure. So higher interest rates, lower demand, lower transactions, lower lower closures means less sales for a lot of property companies out there, or builders at least. So, okay. So just an article that was published today, it says here, warnings of a stock market bubble finally proved too much for the S&P 500. So it says here, according to this article by Bloomberg, wagering on the stock market bounce was always a long shot. Now it looks like a sucker's bet. What does it mean by that? It says here, quote unquote, valuations do seem stretched on most earnings multiples, but when you insert the level of growth and the fact that growth is slowing, they look even more stretched, according to Peter van Doojeweert from Man Solutions. Further, he said, either the Fed needs to pivot and rates have to come down, or when the Fed pivots, earnings will resume a very strong growth trajectory. Those are pretty big things to wish for. So not an optimistic outlay here by the analysts. So he's referring to the PEG ratio, which one of the most famous investors out there, Peter Lynch of Fidelity Investments. The higher it is, the more expensive shares are. So we're at 1.8 times. So we haven't seen this spike since I guess last year, back in 2021. So not a good sign in terms of valuation, as well as when earnings have been dropping. So buckle up, guys. It's might be another year of shakeout for those who have less, what do you call that? Less conviction in the market, might be taken out or might be forced to sell any investments that they think won't do any good in the short term. In the long term, hopefully the market bounces back up. Alrighty, I think that that's my last slide here. You've so Wally, before we end or we go to conclusion, anything else that we want to point out at this point in time?
Well, even in Europe, we're seeing this type of issues going on. Just looking at what's going on in Europe, even landlords in Europe are selling a record number of rental properties in the southeast, according to this article on the Telegraph. So even on rental properties, we're seeing things are changing. People are unloading some of their rental properties to move into cash. So
Wow.
I don't know what's going on. It looks bad. So it looks like they're preparing for something at this time.
Cash
So
is king.
yeah, cash is king again. But looking at the equity market, look at cash flow. So for the stock pickers still looking at possible companies to invest in, look at their positive cash flow. That would help in the long run.
Right. Always look at the bottom line. Always look at the cash flow. See where the money's going.
With higher interest rates, also look at financials, see what they're doing. Current trend today, because of the news, is again financials up, materials up.
Yep. All right. And well, I guess that does it for now. For those who have stayed with us until this point, thank you guys for listening. If anything, you might want to hit subscribe and like button. We appreciate anything. Again, please anticipate the new episode next week around the same time. Again, this is Mark Yu signing out.
And this is Wawi Santos. Thank you for all our listeners. Please like and subscribe.